Hello and welcome everyone. My name is Federico Invernizzi and I'm the Chief Operating Officer at MDOTM. And today we'll discuss how to emerge from the COVID crisis in terms of the markets, of course, and how our AI models have seen and interpreted this crisis and have evolved over time to face this new condition. To discuss it with me, we have Axel Maier, who is the Global Head of Business Development at MDOTM. He has a huge experience in the asset management industry, both in Europe and in Asia. And he's with the company, has been for a while. And we have Tommaso Migliore, who is the CEO and founder of the company. They'll go into two aspects. So first, Axel will introduce what we do and how we offer our services to institutional investors out there and financial institutions. And then Tommaso will dive into what we've seen in terms of numbers, in terms of analysis of the metrics and the information we've seen on the market over the last few months. And then, of course, we'll have time for questions. So everyone, there are already a few people in and still are joining, quite a few as we speak. So everyone is invited to ask questions with the Q&A button at the bottom of the screen. So as we speak, please let us know what you think and what you'd like to know about what we didn't say, so that we can go to that after the presentation. I'll leave Axel to introduce what we do, and then see you in a bit for the questions and for Tommaso's part. Thank you, Axel.
Thank you, Federico. Welcome, everybody. Good morning, and thank you for joining us. Having information is not really the challenge anymore these days in making investments. There's an abundance of information out there. There's a lot of data out there. I think the challenge has really become to find the right data that is helpful, that's reliable, and that's clean. So investing has become more than ever a tech challenge. And this is at the core of what we do. MDOTM provides understandable AI strategies that you can control. And the understandable part is very important to us. And you will see when we go through the presentations today that, we try to make sure that AI is not seen as a black box. It's not like the magic box that can do everything. We will show what the boundaries of that are. But it's very key that our clients do understand what AI does and what our AI does. The models are developed by, basically driven by two groups. One, we have a very creative team of innovators within MDOTM, and also in a very close cooperation with two of the leading Italian universities in that field. And that's matched with the insights we get from industry veterans within the company and outside, to make sure that the models we create actually meet the client needs, the objectives, but also reflect, of course, the ever-changing regulatory environment. And within that context, we do offer 4 different things. We have a multi-asset strategy, an equity, single equity strategy, both of them also in ESG format. We have a hedge fund replication strategy, and we do offer a proprietary trading strategy for our clients. That can be accessed in 3 different ways. One is portfolio diagnostics, where basically we look at a client's portfolio and help the client to find the strength and the weaknesses of that portfolio using stress tests that are developed by our AI. And at the end of the day, we want to make sure clients have portfolios that actually do what they're supposed to do, and we help with that with a cost-effective rebalancing proposal. The second one is an asset allocation enhancement, where together with clients, we provide a bespoke monthly asset allocation on a regional and sector basis. We do support the client's investment committee in that regard. And of course, it's a reoccurring thing. We really want to make sure that it's understood what our AI does and how it does it. So we do a lot of workshops and trainings with clients to make sure they feel very comfortable with using this new technology for their investments. And lastly, and that's the core of what we do, is portfolio advisory, where basically we provide portfolios to clients on an ongoing basis. We manage these portfolios with the exception to the client who do the implementation of it. it includes very adaptive changes, and some of that you will see later on in Tommaso's part of the presentation when we show you how the model actually reacted during the financial crisis. This is just a quick snapshot of the two of the key strategies, multi-asset and equity, how they have done over the long term. And then, you know, what's of course more interesting for most of us, how have they done this year during the financial crisis? And you can see that, you know, both strategies delivered what they are supposed to do. And that's the key thing for us. I mean, having an outperformance is nice, but it has to be an outperformance for the right reason. And in both cases, you know, we developed models for clients, and even with this in this very tough time, you know, we could show that these models actually perform in the way they are supposed to perform. So why is AI a game changer in investments? Well, it's all about perception and misperception. If you look at these two pictures and think, what's the difference? It's not very obvious at the first glance. However, if you just put them around, you see that on the left side, you know, the eyes and the mouth were upside down. And so this is kind of, seems to be a very trivial example, but it's that idea of finding something that's not that obvious and making it right. And it's also very clear that we want to make sure that, you know, AI it's really just a tool for us to reach investment objectives that are given us by our clients. It's not the magic solution to everything. It's not the crystal ball. It did not predict and could not predict the financial crisis, but it reacted very, very quickly to it. So at the end of the day, everything begins with finance. And so what we do, we use very approachable, clean, correct financial data. And this is then also in the use of that data where we can see what's the main differences to quantitative models. And so if you think about that square here, as that's the financial market, including the dynamics, the data within that financial markets, and of course the securities within these markets. So you can, of course, build a quant model and an AI model that capture part of that market and of these dynamics. But then, of course, what happens over time, and this is one of the key differences between quant and AI, is the AI model learns. It learns how to adapt, and it learns that quickly. So it moves with that financial market. Whereas a quant model needs to be manually readjusted to reflect the new environment. And so this is the big benefit. And we also say, you know, AI is not necessarily quant, since it makes that adaptation, it learns, and the learning, and we will see this later when we go through how the model actually reacted in the financial crisis, that can save a lot of money, a lot of your money. Another way to look at that is if you think about the pharmaceutical industry as an example. So usually the clinical trial is the last part of a drug development program. And within, if you think about how if you compare that to quant, so if you would just have two groups, one that gets a placebo and a real drug, and then at the end, you would say, well, you know, the drug seems to work. So if this would be your entire assessment, that could be compared with a quant approach. Whereas what actually happens in a pharmaceutical trial is that, you know, you don't only look at the outcome of the drug trial, but also you think about how the different components interact with the different cells, with the different programs, etc. And then you come up with a development. So there's a constant adaptation and learning of reactions. And so this is maybe how you should see how the quant and AI differentiates.
Basically, now to go a little bit more in details on what we actually do is, you know, taking the example that Axel just presented, we see the same thing happening within the financial industry. So this is a traditional backtesting, which is very comparable to a clinical trial, if you think. And the problem with traditional quant model, they can be, you know, do it very, very well, but most of the time there is a big problem, which is basically the overfit. And the problem is that quant models are developed using econometric. Econometric kind of struggle to talk with the complexity of the financial market. And basically, quants, to develop the model, they have to rely on backtesting. They have to rely on a lot of assumption, and we can just project those assumptions on this plane. Now, if you look at this chart at the bottom, you find that the vertical axis, that's the return. So the higher the point, the higher the return of that model. These axes, the left axis, that's the look back period, how much you go back in time to basically evaluate your parameters of the models. And then on the right hand side, there is the holding period, basically how long you keep a security in your portfolio for that model. Now, all these little points, they represent different model configuration, different parameters, etc. If you think about it, how a quant would develop a model, they would just use statistics and sample possible model configuration, doing in-sample analysis, cross-sample analysis, auto-sample analysis to basically make sure that the model is reliable, but it is always referring to a certain parameter configuration. This is actually where, on the contrary, AI can bring a huge value, and it's something that people don't often look at that in this point of view. But actually, if you think about it, AI actually helps to overcome overfit if used properly. Why? Because those same points, they can actually be seen as a whole surface. So what we can actually do is we can completely explore all the possible parameter configuration. And what's evident with this example is that actually those points that we've seen, those are actually all points on a very unstable surface. So the surface, the parameter configuration, the possible parameter configuration, if explored thoroughly, they represent a three-dimensional surface. Now that surface is very unstable. Therefore, what happens is that if you have an unstable surface, you tend to have unstable portfolios, because the surface, even though in general it's always positive, as you can tell, the surface is all below zero. So on the average of all those parameter configuration, the models are all quite positive, but the problem is that it moves a lot, and therefore your portfolio, your model configuration might be very high. This is where actually AI comes in handy, because this is what the model can actually do. So basically can reiterate all the possible parameter configuration, one after the other, and cycle through thousands of possible configuration, not really to find the best one, that would be doing the same mistake from a different point of view, but actually to find how we can combine them to end up with the most stable surface. So what are the parameter configuration that actually provide a stable surface, not really a best performing portfolio, but really a stable surface. And a stable surface means that the model interacts with the market in a very robust and sound way. And if you think about it, this could be done by a human. You could have a man, a person or woman being there to check parameter after parameter and analyze how it interacts with the market. Now the problem with that is how fast you can go. And this is where actually the machine comes in handy once again, because it actually runs that same analysis, analyzing hundreds of thousands of these surfaces to really make sure that each one of them, each possible parameter configuration, look back period, holding period, and all those parameters within volatility, the return distribution, covariance, you can imagine, those are all very, very robust. So this is why we actually think and strongly believe that AI, if used properly, represent the step to bring the scientific method into investments. So if you think about it, during the 90s, the early 2000s, the quant make a big step into bringing scientific methods. So, cold observed analysis on data, on robust data, to bring prediction, and repeat that on a small sample into a wider sample. But it always failed a little bit because of those problems. AI represents the chance to do the same thing, but just with a deeper viewed into the data. And this is where the actual big value lies. Of course, this adds another example that Axel presented at the beginning, which is if I'm not running backtest, but if I'm actually running analysis to understand how the model interacts with the market, I can monitor that way quickly. And this is why, way more quickly, and this is why actually AI is able to learn and move and understand the market behavior faster than a traditional model, because by constantly making sure that the model understand how these surfaces, how the model interacts with the market, then we can actually see if suddenly all those surfaces are not really meaningful, then it is something that clearly is not working, and the model adapts itself to catch it better.
Tommaso, so to go back to the analogy that Axel told us about at the beginning in the pharmaceutical industry, with this type of technology, you're in the lab and you can observe how this molecule is evolving its interaction, rather than having to wait for a whole set of patients to show their symptoms and become healthier or not. Observe them, wait for all of that, analyze the data, and then go back and find if there is a problem, but rather you are in the problem itself and you're more quick to identify possible permutations or possible behaviors that have changed. That's correct?
Absolutely. So the quickest way to see if a drug is functioning against a virus is not to see if the patients are getting better, is to see if in a lab, if on a little, small closed environment, if actually the virus is, struggling to live, to survive against that drug. So if you can, understand what's going on in that little small example, then of course you can infer that in the near future the patient will get better, and you end up making all those checks because those are needed, but those are at a second level, and then you can always fall back into monitoring how the drug is doing against the virus. And this is exactly what we do, but on the financial market. And the COVID crisis that we experienced in the market, although it has been extremely bad for and as being Italian, we suffered probably more than anyone, especially at the beginning. So it's been very hard on a lot of people and their families, so we're very close to them, but it has been a very nice example for the robustness of our models. We never had the urge or the need to stop them. We were constantly monitor them. Of course, we have a dedicated function inside MDOTM which is called mission control, which actually monitors the model functionalities. But the best thing is that we really saw the model evolving to behave accordingly to the development of the crisis. And I'm going to show you just now what happened. Now, this slide just put things in perspective. This is a very quick slide which shows the top actually worst declines in the S&P 500 and Euro Stock 50 since 1929. Now, what you can clearly see is that everybody keeps referring back to 2008, 2009, which was bad. But if we think about it, this is Lehman Brothers. Okay, this is the number of days since the last peak. Now, before Lehman Brothers, the market was already down 20% over a period of basically 1 year. So we were in a completely different scenario. This is on the contrary 2020. So it was clearly unexpected, as we all know that. Was very fast, and this is why it represented the best chance to test our models and to put them to actually stress. Now, what we will see now is basically some of those surfaces we talked about it in a simpler way to explain what happened and how the model evolved and reacted. Now, the first one is a Sharpe ratio surface. If you think about it, Sharpe ratio is a function of return weighted by risk. So it's a good way to see how information was distributed before the crisis. Now, let's stop a second and see what this surface shows. Now, we have a surface which on the front axis represents the asset classes divided into fixed income, all the way here into govies, bond, high yield, etc., equities, all the way to here, and then commodities. Of course, equities are divided into sectors and geography. What we see on the vertical axis is the Sharpe ratio. So the higher the point on the surface that you will see in a minute, the higher the Sharpe ratio. And then lastly, which is so important, is the look back period, from 6 months down to 24 months. Now, this is actually the surface. Now, this surface that you see, turning, basically represent how information was distributed before the crisis. We're seeing the picture of the 14th of February. What you see here is basically, again, the fixed income. So the higher the point, once again, the higher this, risk return measure. And the best part is that by looking from 24 months to 6 months, we can clearly see that we're not just taking one single, metrics. We're seeing a dynamic in general, without, taking a strong opinion on where you should measure Sharpe, but you can clearly see how in general it was distributed. Now, what you will see now is what happened to this surface, so to the information on the market as the crisis evolved. Now, the first thing is we go from the 14th of February to the 28th of February. Now, this is just before basically the strong crisis. And you can see that, the surface at the beginning basically was just being always well organized, not yet reshuffled. The information was basically the same where we were experiencing the first cases in Europe. But then let's see what happens when it really, burst. And this picture kind of tells it all. This picture shows very well how in a split of a second, we're talking just about a couple of weeks, doesn't matter if you measure the information from 6 months to 24 months, basically suddenly the information was destroyed on the market. And it actually deteriorated even further. Now, how would you behave on something that was so fast and so quick? And the best part is that our model actually completely changed the style of investing. So typically, our models, this is the multi-asset one, but our model prefers to allocate using sectors rather than geographic areas. And the reason it prefers sectors is that if you think about it, let's take, I don't know, the S&P 500. The sectors, the S&P 500 is a linear combination of the sectors inside, the various one, technology, healthcare, oil and gas, etc. So the models that aims to build an optimized portfolio by working with variance and covariance, so with correlation basically, works much better by taking bets in sectors rather than take the whole geographic area. But what happened during the beginning phase of the crisis was that we saw a collapse in information. So the first reaction of the model was basically to de-risk, not too much, but de-risk a little bit, and rather than move within sector and start, getting false signals, given that the noise, so the volatility increased so fast, the model changed into a geographic asset allocation style. And this is very clever because with the deteriorating of the signal to noise ratio, with the information getting basically down to zero, it made a lot of sense to not get trapped into the wrong size of volatility, trying to catch, false signals that were, spiking all the time, but actually had a slow down approach, diversified as much as possible, move towards a geographic asset allocation, but at the same time by keeping single strong bet that were very limited, but actually were providing a good different revenue stream, and I'll show you in a second. The first one was gold. We had that in the portfolio before, and it provided a good balance. And at the same time, if we look at the sector in general, whilst being on a more geographical point of view in terms of allocation, the model still kept significant bets on 4 interesting opportunities that were, first of all, the Nikkei 225, basically Japanese market, which represented a very interesting different revenue stream whilst the market was all collapsing down, Japanese market was doing the same, but it was doing it in a very different way. And so it provided a good differentiator for the portfolio. And then it kept significant bets that were driven by, once again, more, not really the return possibility that actually paid off, but we couldn't see that, whilst we were in the middle of the crisis, but how that return was flowing in. And those bets were healthcare, was consumer staples, were information technology, utilities, basically all different sectors with limited exposure. But once again, it ended up providing a good, outcome in terms of return as well. But during the crisis, it provided a good way to differentiate the portfolio. And this is actually why the model was able to cope whilst being not trapped into the false signals. And if you think about it, traditional, yeah.
Sorry, no, I wanted to intervene just to help you put it into perspective. So the reason why we've seen this shift in the allocation style, so from specific bets aimed at combining together the portfolio so that you maximize diversification, which is the goal of the portfolio allocation model. What we've seen here is that without the possibility to do that, because that was taken out of the possible options by the market itself, that as we've seen in Tommaso's chart, has basically destroyed all information, all available information that is helpful to combine single assets and micro assets. And so, lacking that, the second best option, which was the best option given the circumstances, was to allocate more broadly across the entire risky asset class of equity, for example, and the spreading between Europe and the US, and of course Japan, and small bets that still kept a little of that information. But this is just to explain further maybe how did this come about. So the reason was the type of information that the model is looking for was no longer there. So there was the need to move to somewhere else. And we've been very happy to see this model do it autonomously. Of course, we kept an eye on it, but we were happy to see an adaptation that made a lot of sense as information was deteriorating on the usual source. And given owing to high volatility, it was impossible to catch specific bets without risking too much. And so we've seen this shift, which happened quite naturally, and so we were super happy to see this and not having to do like a emergency switch off of the model, because in times of high volatility you often see that in quant models, but this was not the case.
Absolutely, and this is very interesting, because if you think about it, if we were to have a traditional model that works, for example, within sector, within the crisis, it will still, try to find information within those sectors. Whereas the best part is that learning feature that Axel mentioned at the very beginning allowed the machine to learn that what was going on was completely different, and therefore the value of taking bets within sector at during the crisis was too risky and not rewarding enough. And this is why it completely changed the style, and has allowed us to basically cope with the worsening of the crisis, and then be able to bounce back as things got better, basically.
I think that again, that's a nice way to close the loop. And I think the key thing is that all these models are built or are bespoke on the guidelines and restrictions given by clients. So the model Tommaso just took us through, if the client would have different objectives, it would not have been successful. So, but these models are basically built around these objectives and guidelines, and then should deliver what they're supposed to do. And if you look at the chart on the left-hand side here, with the year-to-date performance of the multi-asset, we can see very well that it stayed well inside the guidelines and was performing better than that. And I think this is, if you think about what's the edge, what we can provide, it is that that delivery of what the model or what the portfolio is supposed to do. And in both cases, on the left-hand side, the multi-asset one, and then the other side, the European equity one, we can clearly see that these models have delivered that. And then as Tommaso said, although the crisis has very dreadful implications on us personally and economically, it helped us as a young company to show that our models are actually doing quite well and do what they're supposed to do. And I think this is for all investors something very important, that if you invest money in a certain way, that it follows the path that you hope it would do.
Let's say it's a live stress test.
It's a live
exactly.
stress. Yeah.
And also, it's interesting because it's the second one that we seen. In terms of quick ones. 2018 was another one that we that actually could model. Our model could learn from all these things, and it's constantly feeding back information in the training process. So this is a key competitive advantage of artificial intelligence for the overall investment process, because it can clearly differentiate the traditional approach. So if you have a traditional approach and you apply AI on the side, it actually differentiates because the machine is seeing something different, and it keeps evolving in the future. So going forward, 1, 2, 3 years from now, the model will actually get better because computers getting better, and at the same time, the machine is able to capture even more information and be more adaptive and more fit to function within that environment. And we've seen that happening since we started 5 years ago up to now. We've seen that slowly the models are constantly getting better, more efficient, and able to catch details, as we've seen in the picture with Einstein. The eyes upside down clearly represent where the value stands. If we look at AI as a tool to capture a tactical portfolio and capture a good positioning on variance and covariance, this is a good thing. If we don't have to look at AI as a tool to capture a strategic positioning for the next 3 to 5 years, that human can only do that. But in a shorter period of time, 3 to 6 months to 9 months, with a tactical positioning and able to adapt as market moves along, that is where actually AI gives very, very good results. Fede, shall we move to Q&A? I can see that some are flowing in.
Definitely. So I have a few, and I've tried to organize them as they came in, so that they're bundled together into big topics. And I'll start asking them to the two of you. The first one is it's rather broad, and so I would have Axel try to answer it. Is artificial intelligence a revolution or an evolution in terms of portfolio management and asset management? How do you see that?
It's a quite philosophical question.
Yeah.
It is, from my perspective, it is a different way of looking, of doing asset management. I think some of that is we addressed initially when we showed the difference between quant and AI. I do think the unemotional way AI offers to look at markets and react to it very quickly is, for me, it's more a revolution than an evolution. It has been tried before in other ways. Not many of those succeeded. AI it's a new technology within asset management. It has been used in other areas a little bit longer. But investment is also very, very complex. So I do think it's revolutionary what it does. But I think also to say we have to guide that revolution. Not all revolutions led to a good result. So I think this has a potential to be, very, very helpful for investors. But I think it's always necessary to ask how is it working? Do I understand it? What data is used? I mean, it's one of the key things. The quality of the data, the cleanness of data. Make sure that the data is non-disputable. But if it's used within the right way, for me, it's a revolution.
Okay, thanks, Axel. And I'll follow up on that because you briefly mentioned, and we also talked about it earlier, about the traditional models. So we look at AI as compared to traditional models. So Tommaso, what these traditional models are and what are their shortcomings? So we've been starting from there, of course, ourselves. That's the starting point, and then we moved forward, building on that. What do they are, and where do they come short?
So as you mentioned, we started, at the beginning with traditional models, and we were facing the same problems that probably a lot of people
everyone else does.
Everyone else does. But the problem was that we still needed to put a lot of discretion in terms of when we were developing the models. So the best example I could give you is, let's say you want to build a model that predicts I don't know, volatility, something very simple, or a model that it's a macro model, and basically in both examples you would start to come up with basically features, variables that you as a human thinks are valuable. So you would see, I don't know, for the volatility one, you would start to provide different ways to measure volatility. I don't know, volatility, historical volatility at 1 month, 3 months, 6 months, 1 year, 3 year, to kind of give a lot of things to the machine, because for us, to see that it makes sense from a human perspective. And with the macro model, you would think, I don't know, I give GDP growth. Once again, this is all very human, because we're giving the machine what we feel are relevant information for us. But the reality is that the machine takes that information from a completely different point of view. For example, if you give the machine the historical volatility, 1 month, 3 months, 3 years, it can get all that information from the return distribution. So you're actually feeding an information that it's meaningful for you to a machine that actually can learn that thing by itself. So the problem that we were facing is that there was too much human input within the model development, and that we felt was a huge risk and not a huge differentiator to what a lot of investors out there are already doing. So we felt that to clearly bring value to the financial system and the investment an investment portfolio in general, we could bring a lot of value if we would focus to something that was less biased in terms of human biases, and was more able to have his own way, and we could monitor that, make sure that that system could evolve quite fast and differentiate to what was going on already in the market. And that has been a key development, not just on the business perspective, but in the investment perspective, because it can turn out to be different investment solution that bring value to the final client in a different way.
Thanks, Tommaso. I'll move on to another question that just came in that is a little more technical, and we have quite a few questions, and we could go on for a while. But still, if you have other questions that pop up in your minds now, do not hesitate to send them, and we'll follow up. So, getting to this new question from Marco, which is a bit more technical, and so I'll aim it at Tommaso again. He says, where is the learning part of the process? And again, doesn't it look like an optimization for Sharpe ratio, the allocation model? And I know you're smiling because it's something we discuss often. So please.
Yeah, no, Marco's question is absolutely spot on, I have to say. So the surface that we've shown with the Sharpe ratio is just to give an idea on how actually the surfaces are meaningful and what is the information that can be seen, and it's a good way to explain. Actually, what we do is slightly different and far away from what we see. The learning stands in the ability to the machine to learn the variance and covariance. So what would actually be in the learning process is a full variance and covariance matrix. So basically the matrix with all the asset classes. So it's a symmetrical matrix, basically, same asset classes, and you measure the variance and covariance. What the machine does, it learns how different areas within the variance and covariance matrix might evolve in the next month. So if you think about it, we're working in a Markowitz environment. The problem is that Markowitz basically said, let's optimize for the past. That's going to be the same forever. We know that's not the case. Black and Letterman came along. Monte Carlo simulation came along with the resampling methodologies. Basically, always to put a little bit of evolution, potential evolution, either on the on the returns with the Black-Leiterman, or on basically the structure of the variance and covariance with the resampling methodology and the Monte Carlo simulation. These two main category of models, they still represent an issue because Black-Leiterman relies on values, on inputs that once again are external, and resampling is very parameter dependent. How you do the resampling changes completely. So to evolve in that, we actually train the machine to learn how different areas within the variance and covariance matrix might evolve. And this is why during the crisis, this was key. What the machine learned throughout the crisis was that the evolution, the fast evolution of those variance and covariance was meaningless. Whereas there was a more stable evolution in the geographical area, so a wider perspective, rather than focusing on catching each single opportunity in the variance and covariance matrix. It was seen an evolution, a more stable evolution in different wider areas, and this is why it learned to change. And then once again, whilst the client got better, it stick back to the old ways of doing things. I don't know if it was clear enough. But otherwise, we can definitely, go more in detail with the.
There is a small follow-up, but I think there is a small follow-up from Marco saying, so we're forecasting the COVAR using AI, and the answer, of course, you already gave it, but it's kind of yes.
Kind of yes, with the key. Marco is hitting the right spot, but with the key details of. Having on the other side an eye on the distribution of return, because it's always a balance between the two things. So we want to have a good prediction on the variance and covariance, exactly. So you absolutely got it right. And at the same time, we want to have an eye on the return distribution to make sure that we're not exposing ourselves to potential risk in the future that a human eye might not see, but there might be a tail risk on some overexposure on asset classes on the same covariance that might be quite dangerous going forward. So the loss function, to go in more detail, the loss function or the cost function of the neural network aims to optimize at two things, basically. On one side, getting right the correlation and try to minimize volatility, and on the other side is try to optimize return by not focusing on what's the best return, but by catching the tail risk associated to the different return distributions, or rather the distribution of returns.
Okay, there's another question which is fairly easy for me to answer, so I'll do it directly. And the question is, do our models require human intervention? And the answer to that is no, as they're running. So there is no human intervention in the investment process. There is a lot of human intervention in setting them up and monitoring them. So it's not we are at the point where models build themselves and evolve by themselves, or at least in part. So our team has, of course, the core people are in the research and technology part of the company, and so we have researchers doing pure research in collaboration with university for certain projects, and they develop and think of new models and new ways to allocate and invest, and they come up with a model. We have an engineering team that basically starts from that prototype, human developed prototype, and makes it scalable and repeatable and work properly and by itself and all debugged, which is a quite important thing in a software world, of course. And then we have
also,
another
can I just add on this? You don't want to have the same people that actually come up with good ideas on how to train the model and how to capture market dynamics and inefficiencies to be the one to test it. This is why Absolutely. Engineering and R&D are completely separate department. The team, the PhDs that work on R&D, they basically are free and wild in terms of new idea to capture alpha, to capture covariance, and do it in a cool way. But the engineering team that tests on them has to be completely detached. This is why we have two completely different functions in the company.
Fantastic. You said it well. And that's true in general for any type of software. And in this case, it's even more delicate and important to take that into consideration. And finally, so we have the last bit
So yeah, that's maybe like the first level of risk management that we do to keep these two groups separate.
Absolutely.
Yeah. We have a
the
Chinese
second
wall
one.
inside a small company, as our bigger brothers do. But no, we strive to have that very clear and very hard coded in our processes. And finally, we have a third bit of the research team that is mission control. That is basically the guys taking a look every day, every moment at how the models are behaving, if they are behaving coherently with what way they were expected to do, and how they're doing compared to the market, what are the contributors, what are the risks that they're seeing. They basically are doing a part of risk management and a part of check on how things are going according to predictions and how the models should work. And that was that covered quite a bit of the topics. There is not a question. There's quite a few, but I'll go to this one, and it's both for you, Tommaso, and Axel. I'd say comes from Kirsi, and he says, if our AI, it's a little. I'll try to rephrase it a little bit. If we do well in the short term, so we provide alpha compared to the market, which is what we've shown and what has happened in the first part of this year. Who is not performing? So is it the humans, and is it the bad AI not working so well? So of course it's a zero-sum game, and what are the other terms of the equation? Axel, would you like to take a shot at this?
That's a very good question. I think that there are multiple components that lead to success or failure in that regard. So I think part is, I think the quality of data is important, and the cleanliness of data that goes into the model. I think even in AI, at the end of the day, if the models are not built sensibly, the result will not be good. So that there's a human component into that. So if the models are built weakly, then the result will be weak and will be fail. So at the end of the day, I don't think you can blame the AI, since the AI is still told how to learn. And so I think that there will be maybe the deficiency.
Absolutely. And I agree. And it is a zero-sum game. So effectively, also in the long-term perspective. So if we say, human, in the long term, there's always, someone that will do it better and someone will not do it correctly. But to go, I think, more in the details of your question, which is at the core of your question, I think, Kirsi, is why you're able to do better, who you're winning against. I think it's, it lays between, and you suggest humans or someone with not so good AI. It is, the market is made of different elements and actors, as we know. But I think that, our values lies in catching two things. Some market inefficiency that are structured within the market. And that has to do with especially rigidity that there is in the market. So in the market microstructure that actually create and generates some anomalies that we're able to catch, I think, thanks to the machine, better than a human can do it on a shorter period of term. And then a good positioning on risk in general. And once again, I think the positioning therefore is in between. So it's a little bit of structured dynamics of the market, and then some a tactical position that the machine is able to catch better than the human can do it on, or other quantitative more standard system actually can do it, and this is where it allows us to be better.
And if you think about it very broadly, how you would define AI in the widest sense, so it's a combination of human behavior, rational behavior, human thinking, rational thinking. So if we bring these four together, that should be proper artificial intelligence. And what good one would do is keep of course the rationale in it, but take the emotion out of it. And so I think what we've seen with these models, well, if these models can react quickly and don't have a bias, that's where they can perform well. Often, if you have human portfolio managers, and I think we have seen all of that, and maybe ourselves we have been victim of that. We buy a stock and is not performing, well, you just hold on a little bit too long since you picked it and you think it's good, but it's not coming back. So AI doesn't have a bias like this. It's very unemotional about it.
That's very clear. Thanks, Axel. So let's move on to the last few questions, since we have another few minutes left. And the first one is I'd say is for you, Axel, and is about what type of data we're using. So what's the input? We touched on this along the way, but let's be more clear about what goes into our models.
Yeah, that's also, I think, helpful to understand. So, you know, we mentioned a few times how important the quality and the cleanliness of data is. So if the data is inconclusive, for instance, you don't have a clear history of data all the way around. The data sources are not always reliable. So that will, of course, have a negative impact on the results. So in our case, we are very, very clear. We only use price data. So that's undisputable. That mostly comes from Bloomberg. So it's very, very clear data that's going into the machine. I think that's very critical. So, you know, we do think that the complexity of artificial intelligence or of a portfolio that's purely run on artificial intelligence is a lot to digest. So we do not want to combine, you know, noisy data with a very complex investment mechanism that will lead to results. So we want to be very clear that the input is clean, reliable, and can be easily checked by anybody. So short answer, we use price data from Bloomberg.
Thanks, Axel. And super quick to Tommaso, another question, and I'll add a little bit to that so that it's more clear, which is what we've seen, how customized is it, and how standard is it? So what's our take, and how do we work, Tommaso, with our clients?
So the models can be quite, I have to say, quite bespoke, meaning that we don't have a model portfolio and then just adapt towards, you know, what are the needs or what are the different constraints that we get from the client. Actually, we work bottom up, we could say. So we start by understanding what are the constraints, what are the
different type of bottom up, let's say,
yeah,
not to be confused with a stock selection that is bottom up.
Absolutely, a model development bottom up, meaning we start from understanding the constraint of the client, the investment objective of the client, the investable universe, and then the other operational constraint, cost, transaction cost, what type of product, what type of behavior should the product have within the ones that already have in their portfolio, and then we actually train the neural networks to work within that environment. And this is a very important aspect of artificial intelligence that gets overlooked, which is the ability on function within different environments by learning the constraint of that environment, which is completely different than having a model and then adapting it, but I'd rather have the model trained to work in different ambience, if you will, and it gets to a better and more efficient. It takes longer, of course, but it can really end up having a truly bespoke portfolio. So the level of bespokeness is pretty high.
It also means that the result of the model is much closer to the expectations of the clients than if you would adjust a model portfolio and we make tweaks.
Tweak it along the way. Yes.
Yeah, so with the way we build portfolios, it's basically, I think that's the key thing. The portfolio is much more likely to do what it's supposed to do than if you have a model portfolio and that's tweaked.
Sure. Fantastic. So I'll leave the last two questions. I'll combine them together for Axel to wrap this up because it makes sense to touch on them. So what about the company? How big, how do we work, and how do we work with our clients, who our clients are? Because we were brief on that at the beginning, but there are a few questions on this, and so it's maybe nice to wrap things up describing what we actually do in terms of business.
Yeah. So the company is, as Tommaso said, almost 5 years old, so it's very young. It was founded in 2015. in 2017, it was selected by Google as the only European fintech company for their accelerator program for startups, which was a first stamp of approval for the company. It basically started with Tommaso and another Federico, and now has grown to about 20 people, €500 million in assets. We do what we do with our clients is basically three things, and we touched about it at the beginning. The core of us is advisory business, where we run the client's portfolio, very bespoke, and help the client along the line to really understand the AI journey. We also do portfolio diagnostics, where we get an existing client portfolio and we analyze that, and we do stress tests to known scenarios. But then also stress tests produced by our own AI. And through that, we can help strengthening the robustness of the client's portfolio in a very cost-effective way. And in between these two things is an asset allocation enhancement, where we work together with a client who would provide us guidelines and restrictions, and we would build an asset allocation for these clients on a regional and sector level, and could look similar to the portfolio that Tommaso has shown us in this presentation. And so, you know, that some clients use that as guidance for their own asset allocation. They use it as input for some of their portfolios, but it is also meant to give an unemotional advice to clients how they can structure their assets.
Fantastic. Axel, thank you very much. Tommaso, thank you very much, and thank you to everyone who attended and had so many questions. It was a very good conversation, I think. And if you want to reach us, just write an email to ask@m.m.eu or any of us. So our emails are name.surname@m.m.eu. We'll be of course answering all of your questions, and we'll be sending out the registration of this webinar and the materials that we used later today. So you'll have that as a reference in case of further doubts or if you want to inquire further. Thank you, everyone.
Thanks a lot.
Have a good day.
Have a good day. Bye-bye.